you have to look at where we are in not only the market cycle, which is that 6 to 8 year typically, or this last long cycle, say where we are in that cycle. And then there's a bigger, what I call a secular cycle. This last one has been about 40 years, going from about 1980 to 2020. So we're in the middle of a market cycle change where I believe we're rolling over, to use the term that's often used in economic circles. We're rolling over from cheap money, low cost of capital, where assets of all kinds have been bolstered in a stimulative marketplace where the Federal Reserve has kept interest rates low and injected additional liquidity into the economy, starting back in the 2008 Great Financial Recession, and then quadrupled that coming into the COVID pandemic. So if you owned or held or controlled any kind of real tangible assets, or financial products for that matter, everything went up. Now, the problem with thinking that that's the way it always works is what we call recency bias. I recently did a podcast on that. I won't go back into recency bias other than to say that you cannot look back in any kind of recent history, and that can be a relative term. That could be a year back, could be 3 years back, could be a decade back, could be 40 years back. Depends on how you want to look at history. But you can't look at any kind of recency bias or what's happened in the past with any predictive promise of what it may look in the future. And that's what I see too many well-meaning people do. People who have built their stakes, made great inroads, been very productive and profitable, let's say in the real estate marketplace in the last decade, dozen years, half a dozen years, last 2 or 3 years for that matter, are just saying, hey, don't worry about the higher interest rates. Don't worry about the sluggishness of the economy. All you got to do is just invest. Whether you're investing in funds or syndications or single-family rental properties, just invest. Don't worry about it. Just invest because long-term, real estate always goes up. Well, that's not true. In fact, in the 2008 Great Financial Recession, interest rates were going down when the Fed was trying to right the markets. Interest rates were going down, and instead of real estate going up, real estate was going down. So interest rates going down, real estate going down. It's not a congruent cause and effect. There's always lag periods, and that's what people don't understand. So it's not about timing the markets. It's understanding the big waves of the market. It's understanding how to look at these big waves and where to position. There's another training that I do often called the capital stack. I'm not going to go into that today. It's a whole nother level, but understanding the capital stack as an investor is very, very critical piece of how you can be on the forefront of investing and being your best advocate. So investing in the capital stack, most people invest in the equity side of the capital stack. That means ownership. Traditionally, that's where money is made, whether it's in business or in other tangible assets like real estate. Having some ownership or a share of ownership in the equity portion of the capital stack is where the tax benefits come from. It's where the ability to leverage comes from. It's where the inflation or appreciation or value add comes from. This is traditionally where people go. And I'm not saying it's wrong. I'm just saying that when you go through some major shifts in market and secular cycles, that's a time to be much more cautionary. I'm not saying not to do anything. I'm not saying to stand still. I'm certainly not saying to put your head in the sand, but it's time to maybe reposition where you are on the capital stack. And the other flip side of the capital stack from the equity side would be the debt side. Now, the debt side, and I'm not speaking from debt as a liability, like when you borrow money to buy a home or a car or a business or practice. I'm talking about debt as an asset, where you or your entity or your qualified retirement account becomes the lender, just like a bank. That's the debt part of the capital stack from a creditor standpoint. Now, that's a very safe place to be when you're going through a market cycle and you're just not sure where the whole correction or market cycle shift, you're not quite sure where it's going to land. You know, we hear the Fed talking about, well, what kind of landing are we going to have coming out of this recession? And the Fed talked about, you know, a soft landing. And then other people saying, well, it's going to be a hard landing. And other people say it's going to be a complete bust. Well, it's going to probably be something in between, right? I think with the longer upcycle we've had and the more artificial pumping up of the economy with the Federal Reserve and Congress, both from a monetary and fiscal standpoint, juicing the economy with more debt. Again, that steals from the future. You have to pay that back sometime. Even the United States of America, with the dollar as a reserve currency, is going to have to pay the piper at some point. How long they can kick the can down the road, nobody knows for sure, but at some point. So you can't keep playing that game forever. And hedging your bet by moving sometimes from the equity side of the capital stack to the debt side of the capital stack can be a smart move. Well, just for instance, treasuries, short-term treasury bills today, whether it's 4 weeks or 90 days or 6 months today, relatively on the short-term end of the stick, are paying 5% plus. We haven't seen that in over like 15 years. So that's being on the debt side. When you own treasuries, you own debt that's being backed by the U.S. government. Pretty darn safe debt, and you're getting paid over 5% to have what we consider a risk off, or a relatively almost 0% chance of risk at all. Why would you take a greater risk right now in equities that might, and again, the whole point is they might pay maybe 8 or 9 or 10% might pay, but the risk is they might not pay at all, or might pay much less because, again, we're in the market cycle. I'm not saying, again, that you should shy away from equities. It depends upon where you are in your position of your life. If you've got a lot of runway where you anticipate you'll be, quote, working, trading your time for dollars, being productive in your business for some number of years, you've got more opportunity to take what I call a little bit more risk. If you're on the more of the ender cycle, where you're closing out, getting close to the end of what you want to consider your very high active income producing portion of your life, you probably don't want to take as much risk, and maybe you want to be a little bit more shy on the equity side for now. On the other side of a correction, a downturn, that's when the opportunities to buy back into equities can be a great opportunity. And that's, again, what I was able to do coming out of the 2008 Great Financial Recession, when I, along with my private capital lender cohorts, I don't use banks, but I still leverage, and I use leverage, either debt or equity leverage, through private capital lenders. We could buy with all cash because the banks were lending. So when you have access to cash, doesn't have to be your cash, but you have access to other people's cash and know how to put together joint ventures, then you can ride that new wave up again once you know and realize that just by doing the math, that the acquisitions you're making in a down cycle, somewhere in the down cycle, make a lot of sense. There's no perfect timing here, but you have to have some experience to understand where you are in the cycle, to understand if this is the time to pull the trigger. Otherwise, you take what I call higher ground on the capital stack. Again, that's going to differ for where you are in your life, what your goals are, how much you need to replace active income with immediate income, cash flow today, how much capital you have in qualified retirement accounts that may be locked up for some years until you're 59 and a half or older, when you can actually take it out without paying a penalty. There's a lot of considerations, and there's no right answer for anybody. That's the key. I'm not giving you advice here personally because I don't know your personal situation. But until you are able to look at the variables and understand the variables and become your own financial advocate, you are just rolling the dice. Do you realize that? You're rolling the dice and you have no game plan. I've seen too many plans made by well-meaning financial advisors, financial planners, who are still playing what I call the accumulation game with their clients, because that's what they know. The accumulation game is what you do on Wall Street, where you put your money in stocks or bonds. You have the 60-40 portfolio. It's been standard for many years. It's a model that I think is old and is old as the hills and doesn't make any sense at all today. But these are standard models that the financial world has used for years because it's safe. It's safe for them. As long as they follow the, quote, rules of Wall Street, then even if the market tanks and you lose a lot of your capital, which happens again through every major market cycle, 6 to 8 years, this last one being a longer one, but I think we're going to see a very strong correction. They don't get in trouble because, again, it's just part of the game. If you don't want to go through that, which I don't anticipate that any of you listening wants to, you're going to have to do some work. There's no freebies. This is the bright shiny object you go to that's going to be the end all, it's going to save you. There's no such thing. You have got to put yourself in a place where you do the work like I did for 20 plus years on my own behalf, creating my own network, my own ability to acquire and create these Plan B assets in real estate through a network, through other people. You can do it that way. If you're younger, that's a great way to get started. If you're a little bit older and you don't have that kind of time, you don't want to waste the time, then you need to collapse time, full time, by finding a group or a network that will help you do that and speed that up. That's really what we do in Freedom Founders. But you may not be ready for Freedom Founders. It may not be something that's right for you. That's okay. I just want to give you a message to think about, because there's no time like today to start figuring out your game plan for tomorrow. This economy that we've got today, that is basically held up on stilts, in my opinion, ready to collapse at the first sign of the tide rushing back in, or a hurricane storm of any size is going to blow it over. Where are you sitting with any kind of safety or hedge positions with your wealth? It's a travesty to see people who have worked really hard all their life, done the right thing, been relatively disciplined in their life, and have put money away wherever they were told to put it, only to see that when they're getting toward the end of what should have been a good long career, and see 25, 35, 40, 50% of that washed away, literally, or figuratively I should say, by the economic downturns, because they had no idea, and their financial advisor can only do what they can do. If they're all tied to the financial markets, that's where you get beat up. That's not saying that the tangible asset marketplace, business or real estate, is not also susceptible to the cycles, but you have so much more control because you've got proximity to those investments. Proximity meaning either you're in that business, or you're managing that real estate, or very close to it, like I did for many years. I had other managers helping me manage what I had, so I'm close to it. Does that take time? Does that take energy? Absolutely. Was it worth it? Well, I'll tell you, I was able to escape the chair almost 20 years ago and have enjoyed the second half of my life tremendously. And the main thing is I was able to have time to focus on my daughter without feeling guilty. Because when I was with the practice and my daughter was sick so much of her early life, I was torn. I had this responsibility of a dental practice where patients and staff were depending upon me to be able to show up and carry my load, my weight, right? Because that's what you do when you own a business and you're the producer or a primary producer. You got to be there. And there's nothing wrong with that. But when are you going to have even an essence of some time freedom where you don't feel guilty, where you can take the time off, even if you're not ready to, quote, retire? And I don't like to use that word, but just for context here, I'll use it. You're not ready to retire, but can you just give yourself permission to take some time off along the way, instead of feeling like you have to grind it all the time because you're trying to reach for some number out there, some accumulation number, some millions of dollars that makes no sense at all, because you just think that's what you have to have. And that's the fallacy in the traditional financial model. I hope this has some meaning for you today. I hope that you'll take some level of action on what I'm talking about, because this is a time to do it. I don't care where you are in your life cycle. You may be younger in your career and practice, and that gives you time, but you've also got a lot of headwinds coming your way, so you've got to be on top of this. There's not going to be a lot of leeway like we've had in the last 40 years with the low cost of capital. If you're mid-career, then you're in a really inflection point where you've got to really make sure that you don't take an unnecessary big hit right now. And certainly if you're towards the end and wanting to escape, meaning sell the business, the practice, you've got to know where you're going to put that capital. Because if you're no longer there working your equity in your business, now you are at the whims and the mercy of the market. And if you have never studied that before, you may be in store for a lot of frustration, maybe even desperation. Don't let that be you. Remember, it's your freedom. You've got to stay focused on it. See you next time.